Wednesday. Hump day. And if this week has maybe left your understanding or even your productivity feeling a bit range-bound, well, this deep dive is specifically designed to help us break out of that. We're going to leverage yesterday's market movements to pull out the crucial insights you need for today. Today is Wednesday, September 17th, 2025, and this deep dive covers the key developments from yesterday, Tuesday, September 16th, 2025. Okay, let's unpack this then. Yesterday was, well, it felt like a whirlwind on the markets, really setting the stage for some critical decisions and moves today. There's a lot to consider, especially with central banks pretty much dominating the conversation.
Absolutely. And what happened yesterday, it isn't just history, is it? It's more like the playbook for what's coming next. Understanding these developments gives you a powerful layer of foresight, especially, like you said, with major central bank announcements, the FOMC decision literally imminent. The subtle shifts, the investor positioning from yesterday, it can reveal so much about market sentiment and maybe where we might be heading.
Okay, so digging into yesterday, what were the big forces really at play? From where I'm sitting, that rally in U.S. equities to fresh records, particularly in tech, that really stands out. But was this like a sign of broad market health or something a bit more nuanced, perhaps?
That's exactly the critical question. And it's fascinating because, yeah, we saw those headline-grabbing record highs, but the underlying sentiment tells a more complex story. Clearly, a top driver was the strong hope, maybe expectation's a better word, that the FOMC will deliver a rate cut today. That expectation fueled significant gains. The S&P 500 climbed for a fourth session, closing at 6,615.28. The Nasdaq pushed above 22,348. Both fresh records. And we saw some big movers, right? Tesla jumped 3.6%, Alphabet added 1.2%, pushing its market value over an incredible $3 trillion for the first time.
$3 trillion, wow. An incredible milestone for
Alphabet. Yeah.
But you mentioned nuance. What's the deeper insight there, beyond just the headline numbers?
Right. So while records were hit, it's really crucial to note the narrow market breadth, the strength. It was heavily concentrated in just a few mega-cap tech names. And this isn't just about who's gaining, but how potentially fragile that rally might be. It suggests broader economic participation isn't really driving these highs. It could signal investor caution, maybe a flight to perceived safety within just a few giants, rather than, a widespread return to growth. It's a key distinction, I think, for assessing overall market health.
That's a really vital point for anyone looking at their portfolio right now. Okay, so while tech drove equities, another major story was unfolding in commodities, that significant surge in oil prices, geopolitical supply concerns.
Indeed. Brent crude rose to $68.47 barrel, that's up 1.5%, and WTI climbed to $64.52, up 1.9%. And these hikes were, directly linked to those Ukrainian drone attacks on Russian refineries and pipelines. This immediately heightened concerns over supply disruptions. It basically added a geopolitical risk premium to energy prices pretty quickly. Russia has even warned about potential cuts in pipeline flows, which just amplifies those supply worries for global markets. And it certainly impacts how traders are positioning for future price moves. It's a stark reminder, isn't it, how geopolitical events can just ripple through global supply chains and hit the cost of energy directly.
Okay, so on one hand, we've got this tech-driven equity rally on rate cut hopes. On the other, rising oil prices due to these geopolitical risks. How did other assets react to this?
Well, this complex environment. It's interesting because while risk assets rallied and oil surged, investors were also seeking safety. This pushed gold back up towards record highs, around $3,689 an ounce. And perhaps counterintuitively for some, it actually weakened the U.S. dollar. The dollar index, the DXY, fell to 96.69. That's a drop of 0.63%. And benchmark yields also drifted lower. The U.S. 10-year Treasury yield slipped down to 4.04%.
So what does that combination tell us about investor sentiment, especially going into today's Fed decision?
Well, it reflects how investors are positioning themselves right now, doesn't it? Markets are pricing in a really high probability of a Fed rate cut, and that typically boosts demand for duration, longer-term bonds, which look more attractive when rates might be falling, and traditional safe assets like gold. At the same time, that expectation puts downward pressure on the dollar. A rate cut would typically make it less attractive compared to other currencies, particularly as other central banks might be thinking about cuts too.
Okay, so pulling back for a quick market snapshot, what does this tell us about the overall sentiment and performance across global risk assets yesterday?
Yeah, the why it matters for this snapshot is pretty clear. The market's direction yesterday was just overwhelmingly driven by anticipating the FOMC decision today. Global risk assets, A mixed session, really. U.S. equities, like we said, continued their rally to records on those Fed hopes. But that was a stark contrast to Europe, where sentiment was much more cautious. Indices like the STOXX 600 actually shed about 1.15%. In rates, benchmark yields drifted lower pretty much across the board as investors kept pricing in that expected cut. The dollar softened broadly. Commodities saw crude rise on those supply concerns we talked about, and gold firmed up on safe haven demand. Even Bitcoin hovered near $115 K after a brief dip. It really shows how interconnected everything is and how much hinges on central banks and, well, geopolitical stability.
Right. But to really get the pulse of yesterday, we need to look beyond those headlines and see how these drivers actually played out regionally. So let's take our quick global tour, maybe start in the Americas.
Sure. In the Americas, the key development was definitely both the S&P 500 and NASDAQ closing at those record highs, fueled mainly by the big tech stocks we discussed. Simultaneously, U.S. Treasury yields, like the benchmark 10-year, slid to a 5-month low of 4.04%. Stepping back, this clearly signals a very strong conviction among investors for an imminent Fed rate cut. That seems pretty locked in their minds. What's particularly interesting, though, is that this conviction holds despite, persistent softness in the housing market. The Case-Shiller index has actually declined for 4 straight months, so it suggests the Fed still has work to do to support the broader economy. It's kind of a mixed signal about the underlying economic strength, really.
Okay, so U.S. markets signaling a clear expectation for easier policy.
Yeah.
How did that sentiment translate across the Atlantic? In EMEA, Europe, Middle East, and Africa?
Right, moving over to EMEA. European equities, looking at the STOXX 600, for example, retreated by 1.15%. Banked and insurers in particular sold off. German 10-year bund yields also eased a bit to 2.64%. This cautious tone in Europe reflects how sensitive markets there are to both the upcoming Fed decision today and the highly anticipated Bank of England rate decision tomorrow, September 18th. A 25 basis point cut from the BOE is widely expected, so investors are really watching for any forward guidance there. European markets often react to a mix of global and local factors, and right now, central bank policy is absolutely front and center.
Makes sense. Okay, and finally, let's swing over to the Asia-Pacific region, APAC. Did they follow Europe's caution or America's rally?
Asian markets generally saw gains, actually. Japan's Nikkei 225 rebounded about 0.5% after a holiday, even briefly topping 45,000. Hong Kong's Hang Seng and the Shanghai Composite also rose yesterday. This positive feeling was largely supported by those easing U.S. yields, which makes Asian assets relatively more attractive. And also some optimism, perhaps, over a potential U.S.-China agreement on TikTok ownership. That's still bubbling away. However, it's worth noting that markets like India are still waiting for their own central bank meetings later this month. So while global factors play a role, regional monetary policy outlooks remain incredibly important to watch across APAC.
Okay, so given everything we've discussed, from record highs in tech, surging oil, cautious Europeans, gains in Asia, what should we be watching most closely, say, over the next 24 to 72 hours? What's really going to shape the immediate landscape?
Yeah, that's the critical question now, isn't it? What could derail this view or maybe validate it even further? I think there are 3 crucial items everyone should have on their watch list.
All right, first up, the FOMC policy statement and press conference. This is due today, September 17th, at 20.0 CET. That's Central European time. Markets are largely expecting at least a 25 basis point rate cut. Any nuances in the policy statement, and especially the Fed's dot plot, where members map out their rate expectations, that will significantly shape future rate path expectations. This is, without doubt, the big one today. Second, keep a very close eye on the Bank of England monetary policy decision. That's scheduled for tomorrow, September 18th, at 13.00 CET. Traders are pricing in at least a 25 basis point cut there as well. So the vote's split among the committee members, and crucially their forward guidance. Those will be key indicators for the UK's economic outlook. Could definitely ripple through European currencies and bond markets. And third, looking ahead to Thursday, September 18th, at 16.30 CET, we have the EIA weekly petroleum and natural gas reports from the US. These inventory data releases are critical for energy prices and spreads, especially with the current geopolitical tensions impacting global supply that we just talked about.
Any unexpected drawdowns or builds could certainly move the needle on crude prices.
And thinking about what could change the view, well, A less dovish outcome from the FOMC than everyone's expecting, maybe a smaller cut or more cautious language about the future, or perhaps an unforeseen escalation in those energy supply disruptions. Either of those could pretty quickly invert these current market trends. It could spark significant profit taking across asset classes. It's really about managing expectations against what might actually happen.
So let's connect this macro picture directly to, day-to-day operations and portfolio positioning. What does this actually mean for different roles? Okay, for chief investment officers, CIOs, that steepening 2s10s curve the difference between the 2-year and 10-year Treasury yields, often seen as an indicator of economic expectations combined with multi-month low yields overall. It means carefully monitoring portfolio duration is absolutely key right now. And remember, a hawkish signal from the Fed, even a subtle one, maybe a more aggressive stance on inflation or hinting at fewer future cuts, could lead to a sharp rebound in yields. That would directly impact your fixed income holdings.
Right. And for CFOs and Treasury teams. The recent strengthening of the euro and sterling against the dollar, well, that really highlights the immediate need to review your FX hedge ratios, especially ahead of both the Fed and the Bank of England decisions. Currency movements can quickly impact your balance sheet and profitability if you have significant unhedged exposures. Worth checking those hedges.
And for risk managers, supply chain leads. That rally in crude prices, driven by the Ukrainian drone attacks on Russian infrastructure, it really necessitates preparing for potential price volatility, especially if you're exposed to diesel or jet fuel. The upcoming EIA inventory data will be critical for understanding the near-term supply-demand picture, yes, but proactive scenario planning for potential price spikes is just essential right now. And this brings us to, I think, a really key point for everyone's portfolio at the moment. Look, while U.S. equity markets hit record highs, the narrowness of that rally, driven by just a handful of mega-cap stocks plus an uptick in the VIX volatility gauge, the market's fear gauge, well, it suggests that any adverse news, particularly in the tech sector, could have an outsized impact on broader market sentiment. So the provocative thought is, how diversified is your portfolio really, and how much concentration risk are you actually comfortable with in this kind of environment? It's something truly worth reflecting on as we move forward.
This deep dive is powered by Nextsite, transforming open-source signals into strategy with the Site Connect OSINT platform. You can learn more at www.next-site.com. Subscribe on YouTube and Spotify. Like, share, or maybe comment with the one chart you're watching closely today.